Well, thank you, and good morning, everyone. 350 presentations a year does mean I like the sound of my own voice, so that's just as well. Anyway, an Australian economist's proudest boast for quite a while now has been about our 25 plus years of continuous economic growth and how it's only a matter of time before we're going to overtake the Netherlands as the country with the longest running economic expansion anywhere. I've used that line many times. In fact, I used it here this time last year as well. But of course, there is now a big question mark about the ability of the Australian economy to grow. Can we complete year 26? Can we overtake the Netherlands? Because rather inconveniently, the economy went backwards in the third quarter of last year. The latest read we have on how the Australian economy is travelling at the moment. And as a result, the growth pessimists who have never been far away over the last 25 years have resurfaced as well. So one of the questions I'd like to start off with, of course, is that question, is it all over? Well, this chart here, very basic one on what's happening in the economy, shows you growth in GDP, the broadest economic measure that we all tend to focus on. And for sure, you look at that last red bar, it went negative. But what that chart also shows you, I think, is it's not unusual to get the occasional negative in long-running economic expansions. So we've had those before, 3 times before, as you can see on that chart, and on each occasion where we've bounced out and continued along that growth path. Now, I think that's what's going to happen this time round. That third quarter reading was a temporary aberration, not the indication that something more sinister was getting underway. And of course, we'll get the test of that next Wednesday when the Bureau of Statistics publishes the growth numbers for the end of 2016. Hopefully, we'll see a nice bounce out to confirm my story here. What that negative also did is remind us of a couple of things, and one of those is the weather actually matters. It was actually wetter than usual in the second half of last year across much of the country. Had a big negative impact on construction activity, for example, parts of the mining sector as well. And certainly when I looked out the window this morning, the sky was blue, so that weather-related drag should have eased. It also reminds us, I think, that the politics matters when you're thinking about the economy. If you cast your mind back to the middle of last year, well, we were in what was a very long-running election campaign. It was very divisive. It took us a while to work out who'd actually won the election. Then there were concerns about the makeup of the Senate and the like. And not surprisingly, business and consumer confidence took a hit at the time, and we saw that reflected in how the economy was travelling as well. But these are all temporary effects, and they should reverse. Now, we shouldn't really get too caught up in the blow-by-blow reading of economic statistics. They are volatile, they do jump around. The real reason I think that we should be confident about the outlook for the rest of this year and into 2018 is that the big commodity-related headwinds that have been blowing on the Australian economy have pretty much run their course. These couple of charts here just illustrate how big that kind of boom-bust cycle in key parts of the commodity story have been. So the chart on the right, mining investment spending. Well, we had the biggest mining construction boom we've ever seen. It's been unwinding over the last few years, and that downturn in mining capex has been a big drag on spending in the economy, and also a drag on the labour market as well. The chart on the left-hand side, commodity prices, very similar sort of story. Enormous run-up, enormous run-down as well. And that drop in commodity prices has been a huge drag on incomes in the Australian economy over the last few years. And so while people like me keep talking about this continuous period of economic growth and not a recession in sight, the reality is if you looked at the income numbers for the economy, we were seeing the sort of growth in incomes you would normally think or would normally equate with a recession in Australia. So in a sense, we were going through an income recession. And I'd certainly highlight the importance of that income story as the big risk to think about because it was in place long enough, it did produce some changes in behaviour. And probably the most obvious example there is that if we've kind of lost control of the income side of the equation, then inevitably all of the focus has gone onto costs. So for companies who want to influence their bottom line, it's all been about controlling costs, negative for labour hiring, capital spending. Governments who want to achieve that elusive budget balance, let alone budget surplus, well, if you can't generate the revenue, then the only way to go there is by cutting spending. And of course, for households, if your incomes are only growing slowly, then it just limits your ability to spend full stop. Where you get an extra layer of difficulty here, I think, is when you combine that income weakness with the very extreme policy settings that we're seeing around the world right now. Income growth is weak. We're looking for sources of extra income, and it's encouraged everybody to take on more risk by chasing higher yields, by pursuing capital gains and the like. Well, the good news, though, is that commodity prices have picked up. The outlook for income has improved, and the drop in mining capex is almost complete. So we heard the Governor of the Reserve Bank, for example, say only yesterday that he thought about 90% of the decline in mining capex, that green line again, is now in place. So a little bit more to come, but the worst is certainly behind us. And what all that should mean is it should actually be easier for the Australian economy to grow from here. Now, the point I want to really highlight, though, in this is the turn in the income story facing Australia, courtesy of higher commodity prices that we've seen over the last year. It's changing the income dynamic behind growth quite significantly. And just to give you some ideas here, the chart on the left, it shows you the Commonwealth Bank's commodity price index. It reflects our particular mix of commodities. You can see the increase that's occurred. Now, we're obviously well below those peak levels of a few years ago, but commodity prices today are about 46% higher than they were this time last year. And you can start to see the income effect of this hitting the Australian economy. The chart on the right there, it shows you what's happening with our trade balance. And in a very short space of time, we've moved from running trade deficits of somewhere between $3 and $4 billion a month to running a record trade surplus of $3.5 billion on the latest figures. Well, that $7 billion swing from deficit to surplus is a measure of how much extra income is now hitting the Australian economy, and that's every month, by the way. Where you're starting to see this come through, the current company reporting season, for example, certainly some of the mining companies are doing better on the back of this income story. If I look at the government accounts, you can see some early signs of it coming through as well. We've now got the budget data for the first 6 months of the current financial year, and for the first time in years, it shows the government revenues are actually running a little bit ahead of what they expected to see. So this income story is moving from, if you like, the various price measures into the income part of the Australian story. Now, I don't want to suggest the rivers of gold are returning by any means, but I think we confidently say that the income recession is finally over. Well, given that the negatives are now largely behind us, it's obviously worthwhile asking the question: where are the positives? Where is the growth going to come from here? Well, there's 4 key areas that we're looking at the moment. And one of those is, well, the commodities are going to remain an important part of the story. The chart here on the left-hand side, the blue line shows you growth in our stock of mining capital. And after the biggest mining investment boom we've ever had, not surprisingly, that mining capital stock is now enormous. It's equivalent to about half the size of the Australian economy. And of course, all that investment is going to deliver something, and what it is delivering is a lot more production and exports as well. So rising resource exports, particularly as all those LNG plants come online, is going to be a significant contributor to bottom line growth in the Australian economy from here. Now, I mentioned earlier that the weather matters, and that rain that was a negative for construction and so on was actually a positive for the agricultural sector. Now, every Economist chart set at the moment has a weather map in it, and you can see mine on the right-hand side here, and it's probably a bit hard to read, but basically anywhere that's blue on that map has had above average rainfall. And as you can see, it covers most of the country. And it means there's a major lift in farm production underway at the moment. Now, it's only a small part of the economy, but when you get these enormous lifts, it can make a significant contribution again to GDP growth. So the official forecasters, for example, have bumped up their estimates of the winter grain crop, for example, to 59 million tonnes. Now, it's about 20 million tonnes higher than last year, so it's a lot of extra wheat picks. that will need to be consumed, but it does mean that rural production and rural exports are going to make a significant contribution to growth. The other growth positives, I think, are the fact that infrastructure spending is finally starting to move. And the chart on the left-hand side here, it shows you a survey by Deloitte's Access Economics. And it's the measure of all the value, or the value of all of the committed investment projects in Australia. So these are the ones that have been signed off. They're going to happen. You can see the lift towards the end of that chart. And when you look through the detail, what's driving that list? Well, it's mainly public spending in areas to do with transport, especially in New South Wales and Victoria. So that infrastructure story is clearly starting to come through. The other source of growth that I think will become increasingly important is the Asian income story. Now, we all know that Asian growth rates have slowed in recent times, but incomes in the Asian region have continued to expand at a solid pace. And the chart on the right-hand side gives you some examples, just looking at China. So the black line there, real GDP, as I've said, growth there has slowed. But the other lines on that chart are just different measures of income in China, and they've all continued to grow at a solid pace, as I said. And that income growth is driving some interesting opportunities for Australia. Because as incomes rise, of course, what you see is more spending on goods. So you see it in things like food. People want more of it, better quality. You see it in consumer durables, and it flows through to the housing market as well. It also means more spending on services. So as incomes rise, more money gets spent on education, and obviously people with money, like everywhere, like to go on holidays, so tourism also benefits. Ultimately, we'll see some extra spending as well coming through in areas like health and education. Now, some of these benefits are already hitting the Australian economy. In fact, tourism and education are now in our top 5 exports, which I don't think many people appreciate given the focus on the commodities story. And certainly the upside looks enormous. So my China economist tells me that around about 5% of the population in China have a passport. Well, the other 95% get around to getting a passport. You can only imagine what that's going to mean for global tourism numbers from here. And you can do similar calculations about the education story as well. So we're getting some of the benefits, but there's plenty more upside that we can pursue as well. Now, if I start putting some numbers on this, well, we think the rise in resource exports is probably worth about 1% a year to economic growth. The farm boom's going to add up to 0.5%. The infrastructure boom, probably another 0.5%. And this Asian income story is probably worth about 0.75% a year to economic growth. Now, you've got to give a little bit of that back because we haven't quite got to the bottom of that mining capex cliff yet, and it does look like the residential construction boom is reaching a peak. You add it up, all those pluses and minuses, you get to about 2%. Well, it's a solid base under growth, but it's not quite enough. And we do need a few other things to happen to get up to the 3% type number that we'd like to see in Australia. And that extra result needs to come from a couple of areas, I think, and in particular, we need to see a bit more effort from government and from business as well. There's certainly plenty of opportunities there, which is what you can see in the chart on the left-hand side. I talked about that expansion of the mining capital stock, but other parts of our capital stock have essentially gone backwards in recent years. So our stock of economic infrastructure, for example, our stock of social infrastructure, well, when you scale that by the size of the economy, we're running at levels that we last saw back in the 1970s. So there's clearly a very big task there that we can pursue to get those back to the sort of levels that we need to see to drive the Australian economy forward from here. So, well, where's it going to come from? As I said, I think it's got to come from government and from business as well. What needs to happen? Well, I think governments need to lose their fear of debt. Essentially, there's a pressing infrastructure task here, and we do need to rebuild that infrastructure. We can pay for some of it by selling existing assets and recycling the proceeds, as has been happening. But there's not enough assets to sell, and it's too long a process, if you like. We do need to borrow more money, and borrowing money to invest in infrastructure, well, we know it does certain things. It's very good in boosting short-term growth, and that's what we need to get up towards that 3% figure that I mentioned. But it's also something that adds to income and productivity over the medium term. And again, that's something that we need to see. In fact, every economy needs to see, particularly as the population ages from here. How can businesses help in this front? Well, I think we need a more realistic appraisal of the environment that we're now all operating in. And one thing that stands out, I think, is the chart on the right-hand side. This is a survey that the Reserve Bank has published, and it looks at what sort of hurdle rate of return do companies use when they're evaluating investment projects, and the answer is somewhere between 10 and 16%. Well, in a low-yield, low-return, low-inflation environment, that just looks way too high. It's clearly something that's holding back non-mining capital spending in the Australian economy, despite the pressing needs that we have to push that up. Now, we are in the Lunar New Year of the Rooster, and there's certainly one rooster that we need to pay a lot of attention to when we're thinking about economic prospects over the next year. And that, of course, is President Trump, who has already had a significant impact on financial markets and probably will have a significant impact on not only the US economy but the rest of the world as well. Certainly, I think he's one of the few presidents who's had a financial market trade named after him. The Trump trade, well, it really depends what tweet is coming out of the Oval Office at the time, but anything that's seen as positive, then the trade is to buy US equities, push US bond yields higher and push the US dollar up. Equally, any kind of negative tweet has the reverse impact coming through there. So he's certainly a source of volatility for financial markets. Now, Trump's economic policies, if he follows through on what he's said, will be very expansionary for the US economy, and particularly the focus on infrastructure. Again, was something that no economist will argue against. It will be good for the commodity part of the story that's, of course, particularly relevant for us. But it's also going to be inflationary, and that does mean that interest rates in the US and by extension the rest of the world are probably going to be higher than would have otherwise been the case. So certainly in all of our businesses, we should be prepared for a higher level of interest rates. It's pretty clear that there's a degree of international tax competition coming up, and we'll need to be part of that story as well. The main potential negatives, I think, of course, is the threat of trade and associated currency wars that may come through from the worst aspects of the Trump policy proposals. And like any war, nobody really wins when you go down that particular path. Now, I just want to pick one aspect of that story to focus on today, and that is interest rates. And as I mentioned, there is a risk that we see US interest rates move higher at a faster rate with a flow on to other companies, or countries rather. The point I want to stress, though, is whatever happens, interest rates will still be very low. Now, I like long-run charts, and this is the longest one run in my collection. It shows you the history of interest rates over the last 5,000 years. It was put together by the Bank of England, who wanted to prove that interest rates have never been lower than they are today, and they succeeded in doing that. But what they also highlighted, I think, is that aside from that short period at the height of the Babylonian Empire on the left-hand side of the chart there, the norm for interest rates is they are actually low. The aberration is that spike you can see on the right-hand side, that period kind of from the mid-70s to the mid-90s, where interest rates were high everywhere. Not going back to that, interest rates may be higher than today, but it's going to be more like that very long-run trend than that spike you can see there. And that does have, again, some implications on how we need to think and act. What it's going to mean over time is that lifting household wealth is going to be more about savings. We can't just rely on never-ending increases in our house prices to drive that result. And for businesses, well, lifting profits is going to have to be about focusing on growth and pursuing productivity initiatives, I think. Now, I mentioned the rooster. There is one other animal that's, I think, very important when you're thinking about the outlook from here, and that is the elephant. Now, this is called the elephant curve. There's a bit of a hint if you can't see it. But the reason that this chart is important is what it tells us about the current environment, the risks from here. What it shows you is income growth around the world in the 20 years up to 2008, so before the GFC hit us all. The way to read that chart, the further to the left you are, the poorer you are, the further to the right, the richer you are. And it shows you, as I say, income growth broken down by those income bands. And most of those income brackets went ahead at a decent pace. that strong growth you can see on the left-hand side of the chart. That's all that Asian income story I mentioned starting to come through. But clearly there's a group in that 75th to 85th percentile that went nowhere over that period. And when you look at who sits in that group, well, it's mainly the middle-income population in the advanced economies. So you've got a very large group there who feel they've gone nowhere, in fact probably feel they've gone backwards through that period, who cannot see any benefit at all in all the sorts of economic reforms and policy prescriptions that our politicians have proposed and economists have suggested as well. And clearly that group explains a lot of the unexpected geopolitical developments of the last 12 months and will continue to drive potentially those unexpected developments when we look at the next year. So we have a whole range of elections coming up in Europe, for example, that potentially have the same effect. We've got Brexit still ongoing. There's some important political developments in China as well. So it's certainly, again, a year of financial market volatility, even if the growth backdrop does look better. Now, I'll stop at that point and just say thank you very much for your time today.
Well, thank you, Michael. We do have a little bit of time for questions. The CEDA staff are wandering the room with microphones. If you'd like to ask a question, please raise your hand, and usual rules, please state name, rank and serial number, and please make it questions. Just while people perhaps are collecting their thoughts, I saw, Michael, one of your charts was the rising recent in commodity prices. They have spiked quite significantly, to the surprise of some. Even some of the larger resource companies have said so in their recent public announcements. But now they're sort of coming back down again, not to the previous low levels that we've seen. I think a lot of the Australian resource companies at least have got their production costs down to relatively sustainable levels, but I just wondered whether you had anything further any further comment on that.
Look, certainly huge increase in commodity prices. Nobody expected this time last year. In fact, if you look at the forecasts that commodity strategists have, the most optimistic thought the prices were going to track sideways during 2016. Instead, we've had this big increase. It hasn't had an income effect on the economy. That's why I stressed that we don't think the rivers of gold are returning. We are going to see a retracement in some of those commodity prices. It's already happened in areas like coal. The point I'd make, though, even with a big pullback we've seen in coal prices, they're still 100% higher than they were a year ago. So at the very least, commodity prices have bottomed, and we will see, I think, some at least modest contribution to income growth coming through. But the main point is we've taken out a big negative, and even if you replace that negative with a zero, in a strange way, it's actually a positive for growth in the broader economy.
We have a question over here.
Yeah, thanks very much for your presentation, Michael. John Spear from Flinders University. I was very interested in your comments around debt and that governments should get over their fear of debt. If you had 10 billion extra to spend on infrastructure in Australia, where would you target that at the moment?
Well, I think where you can probably get the biggest contribution to the economy, in a sense, is if we devoted that to transport infrastructure. It plays into the affordability story that's, I think, very topical everywhere at the moment. The one thing we know from the long history of these things that there appears to be a certain amount of time that people are prepared to travel to work, and that appears to have averaged out over hundreds of years at about an hour. So if we can kind of expand the distance you can travel over an hour, in an hour, then effectively you make all of our cities bigger, and you do make it viable for that kind of cheaper land on the outskirts to become available. Something that I think will be very important contribution to fixing the issue with housing affordability in Australia, one that's going to generate a lot of returns not only now, but for the next 100 years. And the reason I stress that borrowing is not a bad way to go about that, it's not all about just more infrastructure, it's about sharing the costs around as well. And I can't see any reason why somebody in 100 years' time should be making a contribution to that rail line, and borrowing to do it and paying interest on that debt is an effective way of sharing the costs around.
If I could tap into about $500 million of that 10, I could think of a few projects at the airport, and I'm sure we'd get our shareholders to lower their investment horizons as well, given the low interest rates that Michael will probably offer us. We We have a question over here.
Thank you. Don Manifold from EY. Thanks very much for a great presentation. In your scenario planning that you might do, I'm quite interested in the sort of the Trump potential for sort of increase in tariffs and, as you described, trade wars and this sort of rising protectionism and cynicism around the world. If on a scenario, and maybe you describe that as a downside case scenario, that those trade wars do escalate as is being described by Donald Trump. And I know economists hate doing this, but could you look into your crystal ball and give some insights on what that might mean for Australia over the next decade?
Sure, and I mean, I suppose I should say up front, in a sense, it's nothing new. Trade restrictions have been imposed increasingly around the world over the last 5 years. We can't just leave all of the blame at President Trump's feet here. It's driven by the fact, I think, that global trade growth has slowed dramatically over the last 10 years. Countries that relied for their growth strategies on tapping into that ever-expanding global trade are not getting much out from it. So it becomes all about, well, how do I... growth comes about purely from the domestic side in that case, and the policy question becomes, well, how do I contain all that domestic growth in my economy and keep it for myself in a sense? And having a lower currency is an effective way of doing that, and that's why everybody wants a lower currency now, why there are the risks of trade wars and the like. If it happens, I think there's two things that play out. Firstly, the US will discover that it's very inflationary. Huge percentage of US production actually relies on imported components. If you make those imported components more expensive, well, some equivalent US supplier isn't just going to pop out of the woodwork. It's going to take time to build all those new factories in the US that they will need. And so for the US, it's going to just lift production costs in general, so inflationary for them. If you think about the rest of the world, though, well, if we just look at China as an example, if what they're exporting to the US they no longer can because it's not competitive or trade barriers and the like, well, they're not going to stop producing those items. They're going to be looking for markets elsewhere to absorb or redirect that trade, and so potentially it's a very deflationary outcome for the rest of the world. And certainly overall, you can be sure that it will be a growth negative. How much? Well, it's very hard to say until we actually get some concrete details on what policies are proposed and, in fact, what the final package looks like.
Well, thank you. Thank you all for your questions. We have run out of time now, so it just remains now for us all to say thank you very much to Michael for getting us off to a great start this morning.